Another month and another RBA rate hike. But pleasingly, the pace of the hikes has slowed, making a soft landing scenario here more likely. Our latest thoughts on the economic and market outlook for October. The 25 basis point increase in the official cash rate to 2.6% was in line with our forecast of successive 0.25% hikes in October and November to 2.85%, as per our Business Insights website. And the RBA are understandably taking note of the cooling property market, the slight uptick in unemployment, and the likelihood of recessions in North Atlantic economies next year. By easing back the pace of rate hikes, the Reserve Bank are keeping on track their dual aim of managing inflation while also trying to keep the economy on an even keel. It's been the sharpest pace of rate hikes on record, up 2.5% in 6 months. And from here, 3 more 0.25% increases are still likely in November, February, and around May 2023. The ability of our economy to adjust to this sharp increase in cash rates and bond yields is going to be a searching test, and asset valuations will continue to be stressed by this reality check of more normal interest rates. It's not the absolute level of the cash rate that's the issue, but the speed at which we've moved from record lows to a neutral rate. However, there are some signs that the supply side of the equation is starting to improve, including lower oil prices, just in time for the end of the fuel excise relief, and a fall in shipping costs and delays. But the imbalance between constrained supply and still strong household demand remains the challenge. Until the RBA see core inflation back down below 3%, we can expect their tightening bias to remain in place, probably for all of 2023 and for a period beyond. As this slows the economy down, it's likely to see the unemployment rate back above 4%. But there are some positives to keep in mind. The rebound in international tourism is supporting hospitality and regions hit hardest during the pandemic. The lower Aussie dollar is encouraging domestic tourism and is also helping exporting businesses. And as we saw in last week's federal budget update, the rebound in our economy has helped net government debt to GDP to fall even lower than previously forecast at 23%. So our AAA credit rating is intact, and the relative outperformance of our economy is important to keep in mind ahead of the federal budget later this month on October the 25th. Next year, we'll see our economy decelerate further from the current 3.5% growth rate to below 2%. The RBA are actively seeking a slower economy and less discretionary spending. However, the smaller rate hike is a sensible step in walking the fine line between minimising the risks to the economy presented by inflation and achieving sustainable slower growth. Similarly, property prices, having fallen another 1.4% in September, will ease further, but as long as the RBA don't overshoot on interest rates, can settle back to more sustainable levels. And that's the market update from Bendigo Bank.